Hey, good afternoon, everybody. Welcome to today's event, Q4 earnings sneak preview. You got John Hopkins here. Tom Bowley going to join us in a very brief minute. I want to take the opportunity to welcome all of you to this event. I know we have a lot of people new to EarningsBeats. Appreciate you taking the time to come in and check us out. I also want to thank our seasoned veterans. Many of you supported this over the years, makes a big difference in terms of what we're able to provide everyone. I want to let everybody know that this event is being recorded. For some reason you can't stick around, understood. We'll make sure you get a recording, as quickly as possible. I'm going to be very brief because I know Tom has a lot to cover. We've got some exciting events coming up. Starting with tonight and right through next week. Tom will go over some of that with you. And then, of course, get into the meat of the presentation, which is why you're here. So let me go ahead and see if Tom's in the house. You there, Tom? I know he's around somewhere.
I am here. I just couldn't find the button to unmute myself.
Okay, well, you found it.
I found it.
That's
I'm
great.
here.
It's really strange, like with the market closed today, but I'm sure things are going to heat up again come tomorrow. It's already been pretty interesting start to the year. So much has happened. And now with the earnings season, really getting ready to crank into full gear. That's what folks are interested in. So let me step aside and talk to you a little bit.
All right, sounds good. Okay, yeah, we got a lot to go over today. It was nice to have a 3-day weekend. I will say that, but I tend to use the time when the market's closed to do a lot of evaluating of the market and so forth. And so I've done a bunch of that. And I want to go through that a little bit today. I mean, this event is Q4 earnings sneak preview, but I think there's more than just earnings that we need to be thinking about. I mean, we've got the new vaccines that have rolled out over the past couple of months. We're starting to see that distributed throughout the country. I know here in the Carolinas, cases had been surging after the holidays, but the last few days we're starting to see the cases roll back over again and start to move lower. And I think as the vaccine is distributed, and of course more people have had the virus. I know in my area, it seems like 6 months ago when we had the lockdown and all, I didn't know anyone that had it. I didn't know anybody who knew anyone that had it. Now it seems like I've got people all over that I know that have had it or currently have it. And so I think we're going to, have a little bit of herd immunity starting to build. And then, of course, with the vaccines, I really think within the next 2 or 3 months, the majority of this is going to be behind us. So I think, we need to evaluate what's taking place in the market. And when I say that, I look at it on a basis of what Wall Street's doing. A lot of folks might not trust Wall Street. I trust them immensely when they're putting their money to work in the market. I believe they know a lot more than we know. And so, what they're doing and the areas that they're moving into and moving out of, I think is really critical. And it was a cornerstone for us back in March, April, May, using the same analysis to evaluate where money was going in making that bull market call, saying, hey, we're still in a bull market. It wasn't a popular call back then. People, a lot of folks thought I was nuts. But when you looked at what Wall Street was doing, we were seeing the gap downs at the opening bell, but then money was rotating. And we were seeing a lot of companies and areas of the market that were being sold off at the opening bell. They were being accumulated the rest of the day. We saw other areas like airlines and recreational services, cruise lines and so forth. They continued to sell off all day. So they had gap downs and continued selling. But other areas had gap downs and then rebounds and buying. And that just told me that Wall Street was willing to accumulate shares in many areas of the market. And that served us well in 2020. But now we're in 2021. We got a different market. We got vaccine news out. So what is Wall Street doing? And I think that's important too, along with this, looking ahead to earnings reports and so forth. So I think, we really need to look at both of these kind of hand in hand. So let me go ahead and pull the agenda up and take a look at some of the things that we're going to talk about tonight. So we've kind of already gone through a little brief introduction. Again, welcome everybody. Appreciate you stopping by. We got a lot of folks here that are EarningsBeats members, but also a lot of folks that maybe are new to EarningsBeats. So I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. I want to welcome everybody in, and hopefully, you'll like the way that we approach the market. And if you do, we certainly would like for you to, take out a trial at least. It's 30 days. You pay $7, but we refund it to you. So really, it's a no-cost trial for those of you that are new to EarningsBeats. But you'll get a number of events, and I'm going to talk to you just for a minute about those upcoming events that we have. But as a member, you are welcome to come into all of our events, whether they're public or paid events. Then we're going to go into evaluating rotations. That's what I was talking about in terms of what is Wall Street doing with their money? I could care less about the headlines. Everybody gets, really wigged out over headline news and, oh my gosh, what do you think about this? Or what is this person, this money manager is doing this and believes this, Tom, what do you think of that? I try to avoid all of that. I think it's a waste of time. It's a waste of emotional energy. And I just want to focus my time on what Wall Street's doing with its money, because I think that's the most important thing. And so we're going to get into some of the rotation that's taking place. Some of it's the same that we saw in 2020. Some of it's different. And so we'll talk about that a little bit. The emergence of some new themes. That's going to be an interesting topic. But again, I think it really is important as we head into earnings season that we have an understanding of what Wall Street is doing with their money and where these different themes are emerging and what some of the things maybe we can look for in earnings season. I do want to just briefly talk about the model ETF portfolio because we do have a big event tomorrow. Tuesday, it'll start at 5:30. I think in one of my writings this weekend, I think I said 4:30, but it actually will start at 5:30. And every quarter, we started the model ETF portfolio back in October of 2020. So we just started it. And we're about to wrap up our first quarter. Tomorrow will be the last trading day of this quarter. Our model ETF portfolio is up over 15%. The S&P 500 is up less than 10%. So we've had a pretty nice quarter relative to the S&P, and it's based on themes. It's based on trying to outperform the S&P 500, putting our money to work in certain ETFs that we believe are going to outperform the S&P 500. So you've got diversification, but you've also got a few little areas of concentration that we like to try to tweak to beat the S&P 500. There's a webinar, an event that we did that's on YouTube. You should go check that out if you haven't seen it. The way that we put together our portfolios and our strategies and so forth. I think it's pretty cool. We also have an Excel spreadsheet. It's our ETF analyzer. And that is also described in that webinar. I don't want to spend a lot of time on that tonight. I will talk about that more tomorrow night. But tonight it's more just about just a couple of quick things about our portfolio, model ETF portfolio, some of the strategies, some of the things that we go through. We'll take a look at maybe a couple of the ETFs that have done really well in our portfolio this quarter so that you can kind of get a sense of what we do. I know we've had some questions come in about our ETF portfolio, like how many do you have in there? Last quarter, we had 8. The highest weighted ETF was 20%. We had one ETF that was 20%. It was an online retail ETF that actually did extremely well, or has done extremely well this quarter. And so that was our highest weighted. And then we had all the way down to our lowest weighted, which was pretty aggressive play on renewable energy. So we had 5% just in one ETF, PBW. So we'll talk a little bit about that. January earnings reports. I'll go through some of the reports that have already come out this month and just point out some of the reports that I think have been really strong, companies that I would be interested in, especially if we get pullbacks. And then we're going to talk a little bit about the earnings coming up this week and some of the charts that I think look really good. I'll probably go through a good number of them pretty quickly, just to point out yay or nay. I either like it going into earnings or I don't like it going into earnings. And I'll show you how I do that. And then we'll kind of wrap things up. So that's the agenda for tonight. And hopefully, I try to do these in about an hour. Hopefully we'll get done in an hour. It might roll a little bit longer, but if you do have to leave, it is being recorded. And we'll have the recording out later. So you can always come back and check it out. So if you have to leave for whatever reason, don't worry about it. We'll make sure you get a copy. Those of you that are not in our EarningsBeats community that are coming in directly, maybe off of a link I put in an article, we'll make sure that you get added to our EarningsBeats Digest newsletter. It's a free newsletter, no credit card required. You can unsubscribe at any time. The benefit there is that when we do have recordings and so forth, if it gets sent out, you're in the community and you'll get a copy of it. So it's really important to be a part of that. All right, let's go ahead and get this thing started. I want to start with the upcoming events. So let me show you our event calendar. All right, so here's our event calendar. And by the way, if you go into our website, you should see it even as a non-member. You should see up here. So you can always come in and check and see what events we have coming up. Of course, we're doing a sneak preview tonight. Tomorrow night is the one I was talking about, the Model ETF portfolio. Next Monday, this is for members only, but it's going to be an enhancement basically of this webinar, Q4 earnings, where I'm going to go out and look for what I think are the best companies and when they're going to be reporting. And we're going to go over those next week, pull up the charts and take a look at what we might expect. I'm going to be looking for some blowout earnings this quarter. I think there are going to be some not only big earnings reports, but I think there's going to be a lot of raised guidance. I think companies are beginning to see the light at the end of the tunnel. I think that's kind of what's happened with the vaccine, starting to be rolled out, the good news we had back in November, and now the distribution that we're seeing somewhat on a limited basis, but hopefully that'll pick up throughout the country. And so I think there are going to be some really good reports out. And if you are new to EarningsBeats, I can tell you earnings are central to what we do. Of course, technical analysis is extremely important, relative strength. We marry the two together. And I think that's really one of the things that makes us unique and differentiates ourselves and our service away, from some of the other services that are out there, is we really focus on both. My background, I was in public accounting for 20 years. Passed the CPA exam many moons ago. So, earnings are important to me. I think in this low interest rate environment, the earnings growth that we're seeing is what's driving the stock market higher. I don't think that's going to stop anytime soon. And so next week, that Q4 earnings webinar will be a big one, I think. And there probably will be some others because I've got some things in my head that I want to convey to our members and so forth. So I know we have there's a January effect webinar that I like to do in January. So you might see this going on the calendar at some point later in this month, or perhaps the very beginning of February, but probably the end of January, where the January effect, how the market does in January, tends to give us a really good idea of what we can expect the balance of the year. And I'll talk a little bit about that. I'm sure I'll be writing articles about it if we don't have a separate event. But anyway, the next event you can see Tuesday, February 16th. That'll be the Max Payne. We saw what happened on Friday. Good gosh. I wrote articles. I mean, I want to educate as many people as I can because it is absolutely criminal. I call it legal criminality because there's nothing wrong with what market makers do. But if you don't understand the role of the market maker and you don't understand these options when they expire on a monthly basis, you are doing yourself a tremendous disservice in terms of trading. I wrote an article in Don't Ignore This Chart blog this morning. I've been writing a lot of articles last few days. It's like I'm trying to get this information out as best I can. But Enphase Energy, one of our portfolio stocks, stock was down. It was the biggest loser in the S&P 500 on Friday. It's been a tremendous performer. It had so many in the money calls, and literally it was like the carpet being pulled out from under everyone. And I showed in the Don't Ignore This Chart blog how the net in the money call premium on ENPH dropped $100 million. That's how much market makers saved by one day of bad performance on that stock. Long term, it's not going to make any difference. Enphase Energy is going to do what it's going to do based on earnings. But in the short term, that one day pullback like that on Friday was a huge, huge savings to market makers. And no one would ever could ever possibly convince me that they weren't shorting the market, many of the stocks in the market. You know, I wrote another article, talked about how all of the low scooter sectors and low scooter industry groups performed well on Friday, and all the high scooter sectors and industry groups performed poorly. So anything that's been rising struggled on Friday. Anything that's been going down was strong on Friday, or at least much stronger than the weaker stocks. It's options. It's options expiration. But anyway, the next Max Pain will be in February. You can see February 16th. And then the big event that we do, we have 4 portfolios, stock portfolios, not ETF portfolios. We only have right now one of those, the model ETF, but we have 4 stock portfolios. And every 90 days, we put 10 equal weighted stocks from 10 different industry groups into each of our 4 portfolios. They've been crushing. Our performance has been incredible. The next draft, if you will, of those 40 stocks will be held on Sunday, February 21st. Now, it's usually the 19th that we do it every 3 months, which would be February 19th, but it's a Friday night. I don't know about everyone else, but I don't really want to do a webinar on a Friday night. So it's going to be on Sunday, February 21st. Nothing will change, obviously. So we'll be hosting it then. Just want to let you know. As far as our performance goes, if you can come in as a non-member and just go to our homepage, and we continually update our stock portfolio performance, which has been outstanding. And we also do this. We have the numbers for our model ETF portfolio. We will be adding that to this page. Because we started with different inception dates, it was just confusing to put it in this table. So we're going to have a separate table for our ETF portfolio performance. All right, let's move on. I want to go through and talk a little bit about rotation. So let me I want to pull up an Excel spreadsheet. Those of you who are not into numbers, your eyes will probably roll back in the back of your head. Those of you that are nerds, accounting nerds like me, are probably going to love it. So essentially what I did is I pulled up, you can see here, the close on November 6th. Then you can ignore high, low, and close November 13th. I'm not really too concerned about those columns. I'm looking mostly at the close on November 6th. The significance here, Friday, November 6th, was the last time the market traded without the positive vaccine news. Pfizer announced on Monday, November 9th, before the open, that they had their vaccine had 95% efficacy rate. And then the following Monday, the 16th, Moderna came out. So what I wanted to do was to see on the close on November 6th and then the close on November 16th. Now we've got 2 positive vaccine news. So when I look at what happened in the market from the 6th to the 16th, it's giving me the initial knee-jerk reaction by Wall Street, by the market. And it's kind of about what you would expect. But I think even more important than that is what has happened since November 16th. In other words, what have we done the last 2 months from November 16th to to January 15th, which was Friday? And that's what I have over here. I've got the period ending November 16th. So that's, kind of what these various indices did from the 6th to the 16th. And then the next one is the 16th of November through the 15th of January. Okay. So this column over here, this does not include the first 10 days of the vaccine news, the 6th to the 16th. This is after the news has come out. And where were we on the 16th of November? This is telling us right here, this column's telling us what we've done since then. So I think these two percentages are really important in evaluating what Wall Street's been saying about the vaccine news. So let me just point out a couple things that are pretty obvious here to me. First of all, small caps. I've got the spreadsheet ranked based on what happened from November 6th to November 16th. So you can see the major indices that I have here ranked 1 to 6, the sectors 1 to 11, and then the industry groups from 1 down to 104 industry groups. Okay. And then the final two columns is showing you what's happened since those first 10 days. So this is the knee-jerk reaction to the vaccine news. And then this is what's happened since. Okay. Now, what you're going to see is that small caps were bid up pretty heavily as soon as that vaccine news came out. Very strong action. The S&P, the S&P 600, the S&P 400, which is the mid-cap index. And then it was the Dow, the S&P, and of course the NASDAQ, which did really well during the whole pandemic. You know, now that the vaccine news comes out, it's kind of like, okay, well, I can kind of understand that. Money's rotating out of the NASDAQ and now moving over into some of these other areas. Same with the NASDAQ 100. All right, so that was kind of like the first piece of analysis, which I think is, you know, probably most who are trading the market realize that small cap's been outperforming. But if not, now you know. Since the 16th, though, from 1116 to 115, these top two spots, small cap and mid caps, they're continuing to go higher. It's not like this was just a short-term little pop. Money continues to rotate heavily into these two groups. I don't think it's going to stop anytime soon. Small caps and mid caps underperformed, have really underperformed for a long time, much longer than they usually do in, you know, looking back at history. And then the pandemic really threw a curveball at them. And so these groups were hit incredibly hard. They're bouncing back rapidly, and I think they're going to continue to. If you look at the rest of the indices, though, the Dow and the S&P, which had outperformed the NASDAQ, now look at the NASDAQ. Since November 16th, the NASDAQ has swamped the S&P 500 and the Dow. So that initial knee-jerk reaction on the Dow and the S&P has not continued. They're going higher, and I think, you know, it's going to be a rising tide lifts all boats kind of thing. I think the market's going higher, and I think we're going to see all the different areas and asset classes move up. But if you want to beat the S&P 500, you need to identify the areas that are leading. And so in my mind, I really like over the last 2 months, the fact not only small caps and mid caps are going up, but that we're seeing that outperformance again by NASDAQ stocks. Now, the NASDAQ 100, which is many of those larger technology type companies, are not doing as well as the overall NASDAQ, which is kind of interesting. And the reason is you got a lot of small energy companies and financials and so forth in the NASDAQ composite that you don't have in the NASDAQ 100. And those areas have been on fire. Just come down here to the sector and look at what's been going on. Number one and number two, initially, November 6th to November 16th, it was energy and financials, and it wasn't close. Energy especially, just absolutely on fire. Since November 16th, energy and financials. This theme right here kind of goes hand in hand with small caps and mid caps, because many of these energy and financial companies are small caps or mid caps. Now, as I go down the sector list, you know, you can see industrials had a nice bounce at first, but they haven't really done very well since November 16th. Kind of interesting. I really thought industrials, and I'm not going to write off the entire year, but I really thought coming into this year, industrials were going to do really well. they have not lived up to that just yet. Again, nice initial pop, but since then, not really doing well. Another really important area that I think, we had a lot of the areas like real estate that got hit hard back during the pandemic. And so the initial reaction, those first 10 days when the vaccine news came out, real estate was 4th out of 11 sectors. But since then, real estate's lost ground over the last 2 months. The S&P's gone up 4%. Real estate's gone down 2.5%. Tremendous underperformance. So what we initially thought was happening, that knee-jerk reaction, has not continued to happen. Wall Street's actually selling real estate companies, which you need to know. The other thing I find interesting is that the 3 groups that have gone down since November 16th, real estate, consumer staples, utilities. The one common thread, they're all defensive groups. If this market was topping and we were going to go lower in 2021, on a relative basis, defensive groups should be leading. They're all taking a back seat. Wall Street has no problems putting their money at risk in this market, even after the huge run we've had. That tells me we're going higher. Wall Street will begin to position in different defensive areas if, in fact, the market is going to struggle, or if Wall Street believes the market's going to struggle. Wall Street's going higher. They believe stocks are going higher. I believe stocks are going higher. Now, some of the other areas, and I'm going to talk a little bit about this, materials, it was, okay, kind of lagged the S&P at first, but over the past 2 months, materials have crushed the S&P 500, basically have doubled the S&P 500 return. Consumer discretionary, a little weak to start, but consumer discretionary has come roaring back. I think consumer discretionary is going to do very, very well in 2021. And we'll talk a little bit about that in just a bit. And then healthcare, communication services, and technology. So initially, again, when the vaccine news came out, this is what I would have expected. I would have expected all of these groups to perform pretty poorly because they are the groups that were performing really well during the pandemic. So we get the vaccine news and you would think money rotates, and that's what happened. But after the fact, consumer discretionary easily outperformed the S&P 500, 685 to 390. And even technology has kept up with the S&P. It hasn't really been leading, and a lot of that has to do with software. But technology, 3.68%, not bad versus the S&P. So it's kind of hanging in there. I think we're going to see some outperformance again in technology. I think we're getting relative consolidation right now, which is okay. I would probably feel a little differently if technology was minus 4% like utilities is right now. Probably feel a little differently about the group, but that's not the case. Since that knee-jerk reaction, technology's doing okay. It's kind of going along for the ride, which is all right for now. Now let's look at industry groups. Look at the number one group in the real estate. Well, number one industry group during the 10 days of the vaccine news coming out. We saw real estate here. We saw real estate here. We saw real estate here, here, and here. So we had 5 industry groups in real estate that did pretty well. I mean, we were in the top 28 out of 104 industry groups. 5 of them came from real estate. And those real estate, you can see 1, 4, 20, 27, 28. What have they done since then? So from November 16th to January 15th, the real estate industry groups, 44th, 63rd, 100th, 49th, and 87th. So that's what I was talking about before. Wall Street doesn't want real estate right now. Some of what we went through with this pandemic, we will see reverse. So there'll be areas that didn't do well during the pandemic, but they'll come back to life. But there are also going to be some groups that this pandemic has set a new paradigm. and things are just changing. And real estate is one of those areas that I think are going to be, if not permanently impacted, I think long-term impacted by the virus. And I can only give you an example. Here, I live about 20 minutes south of Charlotte, North Carolina, pretty good sized city. In Charlotte, if you go into the city, the number of folks that are actually working in offices in Charlotte right now, and I'm sure this is representative of around the country, I don't know how much they're down, but they are down a ton. And little sandwich shops and stuff that used to service people that worked in the city have all shut down. Not just temporarily out. I'm talking about the buildings are empty. Their little shops are empty. I think this virus is changing, in a sense, the way we conduct business in this country. I think we're going to have a lot more folks long-term working from home, which means, or what does this mean for the real estate market, commercial real estate? Who's going to go buy these or lease these huge buildings, four floors on a big tall building for all their employees if their employees are working at home? So this is something I think that's really important, some of the shifts that are taking place. Now, I want to go down to the bottom, and I'm going to go slow here so you can come back and you can look at this later on the recording. But I eventually want to make my way down here to the bottom. All right, so down here at the bottom, you can see the areas that were not performing well during the first 10 days when the vaccine news came out. So we got recreational products, renewable energy, toys, mining, gold mining, broadline retail, software, specialty retail, specialty finance, home improvements, internet, consumer services, automobiles. Let me just say, if you've been a member at EarningsBeats throughout 2020, you know that all of these groups were the groups that were carrying us on the long side back in March, April, and May. And these are groups that we've benefited through the entire pandemic. This is how we've outperformed the S&P 500. These were the groups. So when the vaccine news comes out, it's absolutely normal for us to expect that these are the same groups that are going to struggle with the vaccine news, the rotation. But that's the initial knee-jerk reaction. And that's why I wanted to see what's happened since then. I want you to look at renewable energy, which was 103rd out of 104 when the virus vaccine news came out in November. 103rd out of 104 industry groups. Since then, they're third out of 104 industry groups. So while everybody else was moving out of those stocks back during that 10-day period, I can promise you institutions were jumping in. Many of those renewable energy names have very strong AD lines, which is the accumulation distribution line. And I believe many of these companies are going a lot higher. And it's not just the virus or, how the virus impacts these companies, because I don't think that's really a long-term factor. I think it's more about, or some of it at least, is about the fact that the Democrats have controlled the White House. And I guess theoretically, both the House and Senate, because the clean energy was one of the things on their agenda. And so you've got a lot of money being poured into these companies based on that. So it's not all about the virus. I think there's also some political impacts to how the market trades. And I think we have to be aware of all that. So I just wanted to point out that this evaluation of what's taking place in the market, it's not just, this area of the market went up this day or last week. It's really about analyzing and seeing visually what is taking place in the market. Automobiles, which were 92nd out of 104 when the virus vaccine news came out, number one. It's gone from 92nd out of 104. Now over the last 2 months, number one. Wall Street's buying these companies up. You can sell if you want. but the relative strength tells us to stay in. And this is how we're outperforming the S&P 500. We've had a lot of exposure to the autos, particularly Tesla and NIO. And they've done very well for us. Same goes with renewable energy. I mean, we've had a number of renewable energy names. Recreational products, which again, 104th out of 104, that's as bad as it gets. That was the worst group when the news came out. Recreational products, since then, 22 out of 104. That's pretty good. They're back to in the top 20%. So Wall Street's certainly not giving up on these stocks. So I don't want to give up. Toys, same thing. Beaten up when the news came out, but since then, very, very strong. Notice gold and gold mining, which were really strong during the pandemic. Gold tends to do well when there's fear in the market. So they did really well during the pandemic. Not so great when the virus vaccine news came out. And it's not gotten any better for the groups, these two groups, since November 16th. And those of you, again, who have been with me here at EarningsBeats for the last several months, maybe a couple of years, you know, I've said I don't like gold. I don't like gold mining. I don't like mining. And I'll tell you a little bit why in a couple minutes. But yeah, that's just an area of the market I'm not a fan of. And yet you'll see folks saying, well, we're nearing an all-time high in gold mining. Well, yeah, but the S&P's already moved to an all-time high. So if you're looking at things on a relative basis, gold is underperforming badly again. And I believe the dollar is going to go higher. So, and I'm going to talk about themes now. So I'm going to get back out of this. Let's take a look at some charts. So those of you maybe that are ready to fall asleep with all the Excel information and numbers can wake back up again, because we're going to get into some stuff now. So let's talk about some themes. These new themes, and there's only a couple of them I want to talk about right now. I mean, there's a number of new themes, but a couple of big ones I want to talk about. Number one, retail stocks. And this is why I believe consumer discretionary is going to have a huge year. I mean, these stocks are being bought up so fast, and there are so many people that have been shorting these stocks. There's a lot of consumer discretionary stocks that are among the highest shorted stocks. And so I think we're getting a melt up in the retail area. Many areas of retail, we're starting to see a melt up. So I really like this. This is a theme that it's not necessarily a new theme. I think maybe the extent to how high it's going or how rapidly it's rising might be a little bit of a new theme. I mean, look just here in January. I mean, it's not even pausing to catch its breath. It's just going straight up from the low in January to the high, close to 20% in just the last 2 weeks. Pretty impressive. The next theme I want to talk about, and this is kind of a big deal. I think the dollar is going to rise. A lot of folks are writing about the dollar being weak and how the dollar is going to be horrible. I think they're wrong. I think the dollar is coming back. And this is a chart that I use that has been a pretty good predictor of the dollar as you look across here. This is the US 10-year Treasury yield minus German 10-year Treasury yield here. So this is just calculating the difference and plotting it on the chart. And then look at the dollar index. I think just looking at it, glancing at these charts, you can kind of see there seems to be pretty good correlation between these two. They seems like whatever we do up here, we kind of do down here. And the correlation coefficient down here would agree with me. I mean, it's mostly in positive territory, many times up near 1. And if you look, 0.5 up to 1, you can see many times we've been up in that area. Look at minus 0.5 to minus 1. And we're hardly ever down here. When we have been, we've seen the dollar reverse. So let me show you what I'm talking about. Here, the yield in the US versus Germany is going up. That normally is an indication that our economy is stronger than Germany's. That's why our yields would go up more than theirs or go down less than theirs. Remember, it's just the difference between the two. So it's going up here, it's going up here, it's going up here in these 3 green shaded areas. Notice the dollar in all 3 of these green shaded areas is going down. And notice down here, we're getting an inverse correlation. What happens in those 3 cases? The dollar comes surging back up, the dollar surging back up, the dollar surging back up. Over here, we actually saw the 10-year Treasury yield in the US minus Germany's 10-year Treasury yield going down. But the dollar was going up. That was different than these other three. They're going opposite, but they're doing, in this case, it's the yield coming down and the dollar going up. And once again, we're down here in this inverse correlation area. So what happens? The dollar, instead of surging, the dollar comes back down. It starts to make things right again. Well, take a look at what's happened here just over the past few months. As the dollar has continued moving lower, look at the yields here in the US versus Germany, moving back up again. I mean, this has been a direct look at how far we've gone down now in the inverse correlation, almost as far as we saw back in 2009. And we came roaring back in the dollar. I think we're going to turn up. Now, I think you got to watch about 88.50 to the downside. Okay. And this is a weekly chart showing us, that we went down to about 90 and turned back up again. But let me show you the USD on a daily chart. We got down to 89 and then came back up. Now, when we closed out the weeks, we were around 90, but we got down to 89 and we're starting to turn back up here on the dollar. So this chart isn't even showing you, but we got really close to this prior low. And so unless we take out that low, and we can see the dollar starting to turn back up again, the yield is still rising, I think the dollar could go up. And the impact here, and the thing that's really important to understand, is that when the dollar is rising, that is usually a really bad sign for materials and energy. So here has been the dollar rise over the last 9 years. Here is energy relative to the S&P 500. Now, recently we've been strong, but you need to take this in context of what has been going on for the last 9-10 years. Rising dollar environment, weak energy environment on a relative basis. Same goes for materials. So if you want to know why I'm still a little skeptical about energy and materials, even though they've been doing much better, energy, like I said, on that spreadsheet, energy has been off the charts, been easily the best group. I think that it's played catch up, but I think it's going to struggle if I'm right about the dollar. I think it'll keep going higher. I think everything's going to go up. It's what goes up more on a relative basis. So if I'm right about the dollar and the dollar does turn up, I think it's going to be really difficult for energy and materials to show any kind of significant leadership continue going forward. So that's why I would be a little cautious, those two groups. And that's something that, is going to come into play for the model ETF portfolio on Tuesday night. Because I'm not just going to go rushing into energy and materials based on what I already believe is going to happen with the dollar. I would be betting against what I'm seeing on the charts, which doesn't make any sense to me. So that will be a theme definitely we'll be taking a look at. One last theme, and then I'll move into talk about the model portfolio for just a second. All right, so the last theme for me is the small caps and the mid caps. And so one thing you have to realize is, and I'm going to pull up a weekly, let's go back, let's go back 10 years. And we'll do the S&P 600 small cap and divide that by the S&P 500 large cap. And let's get rid of candlesticks. Don't need the volume. All right, let's just start with this, see where we are. All right, so see where we were on small caps, back in 2018. I mean, I know we had the trade war, then we had the pandemic, and, it's taken such a toll on the small caps. Now, when you look at this and you just look back over the last few months, you say, well, how can the small caps continue to do this? Well, look at where we were. Normally in a bull market, small caps outperform. And you can see from 2011 through 2018, it was a little up and down, but we were trending higher. I think we're going to go back to these highs. That's where I think we're heading. And I wouldn't be surprised if it all happens in 2021 because pent up demand, a lot of folks running back into some of these companies that were beaten down. And no company can grow their earnings more rapidly than small caps. And I believe that is why you are seeing a melt up right now in small caps. When earnings growth of these small caps, starts to accelerate, and it already has, but as it continues to accelerate in a historically low interest rate environment, these companies, what you saw with Zoom and Peloton and some of these other companies that had that earnings growth during the pandemic and how their valuations surged, I think we're seeing it right now again with many small caps. And I don't think it's going to stop anytime soon, unless you think, maybe the virus is going to mutate and the vaccines aren't going to work. And then, yeah, I would get the heck out of small caps and mid caps if that's the case. I don't think that's going to happen. I think we're going to be beyond this pandemic in another few months. I think the light's at the end of the tunnel, and I think Wall Street is pouring into these small caps right now, knowing what's going to happen. So those are some of the big themes that I see right now in the market and some of the things we need to be thinking about in 2021. All right, next up, the model ETF portfolio. What I want to do here is, let me just pull up for you our top weighted ETF, which was the iBuy, Amplify Online Retail. And, I liked this. I don't know if I have the model ETF portfolio one here. Yeah, I do. Okay, so I can pull them up right here. So here's the iBuy. And you can see 63% was in consumer discretionary at the time that we got into it, 18% communication services, 8% technology. But you see, defensive areas, financial services, which I did not like back in October, industrials, I didn't like back then, healthcare, I didn't like, no energy, no utilities, no real estate. You see what we're trying to do. I mean, we've got a group that is clearly outperforming. Look at the scooter on the iBuy. It was up in the upper 90s. It was one of the best performing ETFs. And I'm still a fan of retail. I'm a fan of online retail. I'm a fan of maybe even non-online retail. I think people are going to spend money, and I think they're going to spend a lot of it come spring. And so I expect these groups and the stocks to continue moving up. I mean, if you look at the holdings, top 10 holdings in here, Peloton among the top 10, Wayfair, Expedia I really like right now, Etsy, Stitch Fix. Not only is that company, going up, but the short interest in Stitch Fix was crazy. There's also a lot of short interest in Wayfair. These are the stocks, so when we put these ETFs together, my favorite line, I guess, or my mantra, if you will, with ETFs is you need to know what you own. Don't just, look at an ETF and say, oh, it's got technology in the name and it's done really well, I'm just going to buy it. Well, it might have technology in the name and it might still be 60% industrial. I mean, you don't know. I've seen some weird things. So make sure you understand what you own. And that's part of what we do with our ETF services. We get you a Excel spreadsheet that shows you the top 10 holdings in all of those top rated ETFs. And we keep those in a strong ETF chart list that our members can download right into their account if they're Stock Charts Extra or Pro members. If they're not Stock Charts Extra or Pro members, you can, if they're not either of those two levels, if they're basic or if you're not a Stock Charts member, you can view all of our chart lists, but you have to view them one at a time. There'll be a lot of ads from Stock Charts because you're not a member there. And so you got to, wade through all of that, but you can still use our services, but it's so much better and so much easier if you're already a Stock Charts member, because a lot of what we do, we organize our work at Stock Charts, and we literally you can download our chart list right into your account. A tremendous amount of work that we do. But here's the iBuy. And if we go in and I can pull these up, view all summary. So here are the 8 ETFs. I'm going to sort it by name because I've got the percentages out here That's the weighting that we put into each one of these. And then I'm also going to show you the 3-month returns. So when you look at this, the S&P 500 is last 3 months is up about 9% or 9 and change. When you look at this, 6 of our 8 are underperforming, but just like our stock portfolios, we had a couple of ETFs that carried our portfolio. We're going with relative strength. We're going with leadership. And our largest holding, the online retail ETF, up 26%, which is crushing the S&P 500. And then the smallest one we had, which was only 5%, but it's extremely volatile. And that's why we only wanted 5% in there. But it's been up 70%. Too bad we didn't reverse these, make this one 20%, but that would have been crazy. I mean, it can go the other way too. So you got to be careful. But those two really carried our model ETF portfolio. And that's what we're going to try to do again in the next quarter when we announce our portfolio tomorrow. Now, these other ones, they didn't do badly. I mean, you're still going up on all of them. We didn't lose money on any of them. But, they weren't as strong as the S&P 500. You got the transports. You got this growth ETF. Home builders really have struggled past couple of months. They've been more sideways than anything. Technology took a break in December. It's come back a little bit here in January, but that has underperformed. And internet's also taking it on the chin a little bit. So, but again, it's the entire portfolio that we put together, and our 2 leaders are the ones that really carried the portfolio. All right. So as we look forward to tomorrow night, we're going to be utilizing some of those strategies to put together, looking at the themes that we talked about. I will be looking at there's going to be around 90 ETFs on this strong ETF chart list, maybe a little bit less than that. I will probably narrow it down to about 20 or so that I really, really like. And then I will be looking at the top 10 holdings to get a good sense of, are these stocks within these ETFs that I really like? Because the best thing about putting together a stock portfolio is I can pick the stocks. When you go into an ETF, you don't have any control whatsoever as to what stocks are owned in that ETF. If the fund manager decides to change those stocks, they don't, take a poll to see what everyone thinks. They just change them. And so you're always at the mercy of the fund manager in picking your stocks. So at least when we do go through and make the selection, we can take a look at the portfolio holdings. We can see, is it a widely diversified ETF? Maybe the top 10 holdings only account for 20% of the entire ETF. Or is it heavily concentrated? Maybe the top 10 holdings are 70% of the ETF. In that case, you really want to make sure you're comfortable with those 10 stocks. So again, know what you own. That's the key with ETFs. Don't just go willy-nilly and pick 5 that have been doing well and boom, you think you've got yourself a really well-diversified portfolio. It doesn't work that way. So tomorrow night, we'll show you exactly how you can evaluate your sector allocation, compared to the S&P 500. Make sure that your decisions that you're making with your ETF portfolio are intentional, that you're not just randomly doing stuff, that it's intentional. At least if you're wrong, you know who to point to. Hopefully not me. But anyway, all right, let's move on. January earnings reports. So I'm going to start off first. I've got a few I just want to go over with you that have already reported in January. So let me pull up, and I'm going to pull up, maybe 5 to 10 of them. And these are all that I think look really good. These are stocks that will be on the strong earnings chart list, which is our flagship chart list. We have a number of chart lists at EarningsBeats. So if you're not familiar, and you can download all of these into your account at Stock Charts. But our strong earnings chart list, by the way, currently has about 490 companies on there that have beaten Wall Street estimates as the top and bottom lines. They're liquid, So they trade at least a couple 100,000 shares a day on average, and they look decent technically, or the group that they belong to looks decent. That's kind of how they get onto the strong earnings chart list. But these are ones that will be on there for sure as we go forward. So let me pull these up. The first one, and probably the best earnings report, combination earnings report reaction that I have seen so far this month is with Micron, MU. I really like what's taken place here, and we'll pull this up on the relative chart here. See how it had been going sideways, and if you look at Micron relative to semiconductors, see how it had been going down? Well, semiconductors are very strong, and they continue to be very strong. But look at what Micron now is doing relative to semiconductors. It's now outperforming one of the strongest groups in the market. Okay. And when their earnings came out, there was a gap up. I mean, we were going up. It looked like the market was building up for a really good report, and we had it. Micron reported 5.77 billion in revenues. Market was expecting 5.73 billion. So we beat on the top line. Bottom line, market was expecting 71 cents. Micron posted 78 cents. So we beat top and bottom line. We gapped up right here with the earnings report. And then, and keep in mind, when everybody's buying at the open, market makers are on the other side. So we pulled back. You're going to see that plenty of time. Coming up in earnings season, it'll happen many, many times. Trust me. But I would be watching maybe around 74, 75, maybe even 76 as key support for Micron. It might come up here and fail at about 83. And if it comes back down one more time, you might get it on the 20-day moving average. I like Micron. I think this has been one of the better reports. Now, I talked about materials and how materials, I'm a little concerned going forward because of the dollar. I think the dollar is going to go up. What I would say is this: if you like materials, fine, stick with them. If they start to break down and the dollar is rebounding, get out. That's what I would do. Wouldn't take a chance holding longer term. Not with that 9 or 10-year relative downtrend still in play on energy and materials that I showed you earlier. So having said this, I will show you Schnitzer Steel, which I thought was a great report, great reaction. Well, actually, the buildup to the report was what was great. Huge move up. I mean, we're talking about a stock that was trading at 19 at the beginning of November, went up to 42 and change in 2 months, more than doubled. Then went down for 6 or 7 straight days. It's lost $10. I think probably somewhere in the upper 20s to low 30s is where the stock reverses back to the upside. They crushed revenues, 492 million versus 438 million. Bottom line, 57 cents versus 39 cents. Buy on rumor, sell on news. That's what we've seen here with this stock. AD line, very strong at the top, which I like. Relative strength, just absolutely off the charts. Steel hit about a 10, 11-month relative high here in the last week. So the group's been strong, and this has been one of the strongest performers. And you're getting it on a $10 pullback. Again, I would be using this area from 28, 29 up to about 32 and change. I think this area right in here is a great area to build a position. If you, again, like materials. I don't know that I'll do it because I probably am not going to be jumping into material stocks, but I understand, materials are going up. They still look good on a relative basis. For those who say, hey, I want to stick with materials, I honestly, I can't blame you at this point. I'm anticipating that the group is going to be an underperformer. Right now, they're an outperforming group. So, and you can stick with that as long as it continues to do well. Next up, how about Constellation Brands? There's the earnings, big gap up. That's a shooting star candle off of this uptrend. That's a reversing candle. We've pulled back. I think, though, the 20-day has been strong ever since that vaccine news came out. You can see this is a stock that's been trading above its 20. We're sitting almost right on it. Some of this could have been options related last week. I don't know how heavily the stock's traded in options, but it went down almost every day last week. The group overall is performing well. The relative strength in this group has been pretty good since early November. So this is another stock I think that came out, had some pretty good numbers. Easy beat on the top line, 2.44 billion. versus 2.27 billion. And bottom line, $3.09 versus $2.41. That's a huge beat. I mean, I don't know if you understand how valuations are done, but Wall Street, they've got all their MBAs calculating numbers. When you get companies that are beating estimates and raising guidance, you have to factor that in your future projection of earnings. And when you discount that back using today's historically low interest rates, it creates tremendous jumps in valuations. So, you know, when I see a company beat like Constellation Brands beat, and I don't know if they raise guidance, but if they raise guidance, I'd be viewing this pullback as an opportunity. All right, just a couple more. Now let me show you, I showed you Schnitzer Steel, SCHN. Let's look at another one, CMC. And you see this move up with earnings and then the pullback, 20-day, it looks kind of similar. Well, it's not similar. Look at the relative strength here versus steel. Schnitzer, if I had to pick between the two, Schnitzer would be the one that I took. Now, both of these will probably be on the strong earnings report because this is a company that beat, had a good reaction, and it's part of a group that's been trending higher versus the S&P 500. So yeah, it's not as good as Schnitzer, but it would probably still be on the strong earnings chart list. Let's see. How about INFY? I'm going to give you two more. Or actually, I'll give you four more. So INFY, you can see with its earnings report, look at the AD line, just surge, heavy volume, closing near the high those days. Look at the relative strength, just pointing up. The only thing is that their group, computer services, not been a great group, but this is a stock that's crushing its peers, crushing the S&P 500. Good solid volume trends, nice AD line. This is another one I think looks good. Pullback, rising 20-day, right near that gap support. Something maybe in the mid 17s would look interesting to me. Next up, BLK. This is BlackRock. I think this pullback is going to create an opportunity here. This was I mentioned this one talking about on, I think it was one of the shows last week that I did, Trading Places. But I like this stock because on this move up, you can see asset managers are going up. The stock's going up. The stock relative to asset managers has been pretty strong. And the asset managers group just went up and tested 52-week relative high. So the group's improving. The stock's one of the leaders. They absolutely crushed their numbers, 4.48 billion revenue versus 4.36. So an easy beat on the top line. 1018 bottom line versus 917. So they beat by $1 on the bottom line. I think this pullback is creating an opportunity. I think it's a buy on rumor. They came out with their earnings. I think this is a sell on news. Closer it gets to 700, the better I like it. Okay, last two, I'm going to give you are the two banks that came out on Friday. So Citigroup, JP Morgan, PNC, and WFC, Wells Fargo, all reported on Friday. The two that beat top and bottom line, there were the only two that beat top and bottom line were JP Morgan and PNC. So I like PMC better. JP Morgan, I think, is a solid bank. Can't go wrong really long term with JP Morgan. And you can see JP Morgan moving up, the AD line starting to rise. Banks obviously moving up. JP Morgan, I think overall is moving up, starting to strengthen again here on a relative basis. So I don't have a problem with JP Morgan, but I think I like PNC better. First of all, look at the AD line, setting a new 52-week high. Go back, look at JP Morgan, see where we are versus where we were a year ago. Now that's just one indicator, and it's a secondary indicator, so I don't put a whole lot of stock in that, no pun intended. But PNC, I think not only that, but if you look at the relative strength, its relative 52-week high was just a few weeks ago, and it has pulled back here in January on a relative basis, but the overall group's gone up. I think the overall relative strength is there on PNC, and with that strong AD line, I think this would be my choice of those four banks that reported on Friday. I think PNC is the one that I would be most comfortable with. Maybe JP Morgan, a very close second. All right, last thing we're going to do.
Hey, Tom.
Yeah.
I'm sorry to butt in, but I know a few people were asking, just before you get into this last section, you know, we always have a webinar special, and they were wondering if we're going to have one for tonight.
Okay. Well, we do have a webinar special, and it goes through Thursday. So we got a couple events this week. We got one tonight, obviously, and then one tomorrow night with the model ETF portfolio. We are running a 1-month bonus special. So if you do decide you want to sign up for an annual membership, you can see pricing here, $147 a month. If you multiply that out times 12 months plus the bonus month, it would cost on a monthly basis $1,911. Your price through January 21st, your annual, is $997, and that is 13 months. So, and if you're on trial, you get the rest of your trial before the 13 months begins. So in effect, if you've just recently started a trial subscription, you'll get 14 months. If you're not currently a trial member, if you're in here just for the first time checking things out, I would highly recommend you at least give the service a shot here over the next 30 days. $7, that's what you pay up front, but we refund it to you within a week. So literally it's a no-cost 30-day trial. You'll get all of the events that we talked about earlier. You'll get all those for free, and check it out for a month. And maybe within the first month, you might say, hey, it's absolutely worth the annual cost. But if you do sign up for an annual before or through Thursday, anytime from now through Thursday, we'll throw in that bonus month. So you get 13 months for the price of 12. All right, let's move on to this last segment. And there's a lot of charts in here. I don't know that I want to go through all of these. These are basically the earnings that are going to be released in the week ahead. And what I've done is I've put them all into and we're actually working, Matt Townsend is working with me at EarningsBeats. But I think what we're going to try to do is, as we really move into the heart of earnings season, when you start to see, 100, 150, 200, 300, 400 companies reporting in one day, we're going to try to put together a chart list for each day's earnings. So when I say each day, Tuesday after the close and Wednesday before the market opens, all of those would go into one chart list. And we want to make that available to our members to download so that you literally will have a chart list that will have, on a Wednesday morning, if 200 companies reported yesterday after the close and this morning before the open, you would have those 200 companies in one chart list. So you literally could have the chart list, pull up view all, hit summary, and as they are all reporting, you can then sort it to see which earnings reports are getting the biggest reactions, which I think it'll be really cool service and product for you to use. And if you're somebody who likes to trade earnings, this is going to be a huge tool in your arsenal as far as trying to outperform the market or zeroing in on the types of trades that you want. So I think that will be kind of cool. Now, what I've done tonight, though, is I just have this in order of when they're reporting. So the 001 through 0010 reports tomorrow. 101 down to 113 reports Wednesday. 201 to 217 is Thursday, and 301 to 306, these are Friday. And they're in order of market valuation, market cap. So whichever one's listed first for each day is the highest market cap. So if you like trading higher, larger market cap companies, larger companies in general, then you'll want to stay like 201 to 205 or something, 101 to 105. As you move down further and further, the market caps will get smaller and smaller. But if on the other hand, maybe you want the small caps, based on things we talked about tonight, you'll know that the ones that are numbered the lowest will be the ones that have the smaller market caps. And then when you sort it by value, you'll be able to say, 216, that's one that's going to be smaller market cap. But 102, because it's, started at 101, that's going to be a large market cap company. Anyhow, just some things to think about there, and give you a heads up on some maybe enhancements that we're talking about right now that hopefully we'll have out for you. I'm going to try and put some pressure on all of us here at EarningsBeats and say that by the end of next week, you'll have those going into the following week. So you'll be able to download every day, basically the chart list for earnings for that day. All right, so looking at the charts here, now one thing I would say is when you get these, and let's say, you know, we tell you next week, here's a chart list of 26 stocks that are going to be reporting between today after the close and tomorrow before the open. Those 26 stocks, what I would do is I would take this chart list and I would sort it based on scooter. Now, if you don't see the scooter showing up here, check columns and make sure that the things are, you know, here you could do sector and industry. And now I've got sector and industry. Always you can use these columns to manipulate what you see on here. You know, I can go in here and I can get rid of everything if I want, you know, sector, industry, scooter. You know, I don't even want the change. I don't want percent. I don't want any, I just want the closing price. And so there you have, you know, there you have it. I like to see a lot more than that on here though. Oh, and here's your, you can put the U in there for market cap as well. Let's see, change, percentage change. And you can put volume. Might as well just put them all in there. Okay, so, but what I was saying is now you can take a look to see the highest scooter ranks of all the upcoming earnings reports to get a sense of what is going to, you know, how is it essentially is telling you what market thinks, what Wall Street believes about a company, I think is baked into these high scooter scores. So I could pull up Fuel Cell, and if you're a trader, you know this is a stock that's been absolutely on fire. I believe, you know, it was the combination of the election and the vaccine news that came out. But Fuel Cell has gone from 2 and change up to 21 just a few days ago, probably pulled back $5 because of options. I can almost guarantee you that this was options related. But anyway, the stock has pulled back. Maybe 14 is the number where it pulls back to, hits that 20-day. But I would expect good numbers here or a good outlook based on all of this money that's been going into the stock and the accumulation that's taken place. Look at that AD line. I mean, I think that Wall Street is in on the stock. Institutions have accumulated. So that's one that certainly would be worth checking out. Now, the other thing you can do is look and say, okay, what's coming up in terms of sectors and industry groups? Because there might be an industry group that you really want to focus on. Maybe it's semiconductors. You know, so you've got this sorted by scooter. Let's sort it by sector. And then let's also sort it by industry group. Well, sector. So let's go to technology. And then here are your semiconductors. So we got 2 of them coming up this week, ASML and Intel. Well, ASML is obviously the better performer, although Intel did have a nice week last week. But ASML has been the better performer. So I would look at this and I'd pull the chart up. And sure enough, beautiful move. Sideways consolidation for a while, broke out. AD line looks great. Stock price looks great. Volume trends look great. I mean, everything's going up from left to right. Yeah, this is one of the best stocks out there. I believe, and there's a difference between what a company reports and how a company or how Wall Street reacts. I believe ASML is going to post a great earnings report. I'll be shocked if they don't beat top and bottom line, and probably be shocked if they don't even, you know, raise guidance. I think they'll raise guidance. What I can't tell you though, that necessarily is going to mean price is going to go up, because sometimes we see these buy on rumor. This stock's gone up from 350 to 5.25. Wall Street meets with these companies. They meet with management until the end of the quarter, and then they go into a quiet period. But they were meeting with this company all the way through November and December, you know, finding out what's going on with their products, their gross, you know, margins, competition, and then they go back and they decide whether to buy or sell a company. And so you get this buy on rumor, then the news comes out. Yep, we had a great quarter. And a lot of times you'll see the selling after that happens. So again, thinking that the company's going to come out with a great report does not always mean we're going to get a gap up or that we're going to see a huge move up. If I held a stock into earnings because I was expecting a big number and we got that big number and the stock gapped up $20, I'd probably take it at the open, just like the market makers. I'd be a seller at the open and take my money and run. because you don't know with that gap up which way you're going. I mean, you could be kicking yourself later. This stock might gap to 570, and the next thing you know, it's 620, and you got out at 570. But I think the way you got to look at that is that you're being smart in terms of your risk. And many times stocks that gap up do fall back. So I think that would be a reasonable thing to do if you did hold it into an earnings report. All right, let's see what else. You can see all the banks reporting. That first week of earnings season, it's heavily inundated with banks, many financial companies, banks, asset managers, investment services. Goldman Sachs has improved quite a bit. Let's pull up that chart. So here was your sideways consolidation. AD line was horrible. Look at the AD line now, going right up with price. I was not a fan of Goldman Sachs for a while because it just couldn't break out relative to its peers. It kept downtrending. Last 30 days, not a problem. We are moving up. Morgan Stanley was the one that I actually liked better because you can see both of their scooters now are about the same. But Morgan Stanley, if you looked back here, see how it was breaking out in November on a relative basis? It's continued to do well. Its AD line's moving up. Everything looks good on this chart as well. But Goldman Sachs now has also joined the party. And so I like both of them right now going forward. That's pretty much it. Let me see if there's anything else. Well, Discover 97. It's in, again, financials, consumer finance. 97 scooter. And look at the AD line. That was maybe something that wasn't confirmed in price action back in October and November, but it is definitely confirming now. We're going up. The stock has been going up relative to its peers. It's going up. This is the leader. Now, if there's one thing that would bother me is I'd really like to see more volume on the stock. And it's all relative. I really would like to see dollar volume on these charts as opposed to just share volume, because a stock like DFS, you look at it and you think, well, volume's not very heavy, but you have to realize the stock's gone up from 60 to almost 100 in 2 or 3 months. So the number of shares, even though it looks like maybe it's average or even below average, the actual volume, dollar volume, might be higher, might be quite a bit higher. So that's something that hopefully I've asked stock charts for that. I'd like to see them give us the option to look at dollar volume. And maybe one last thing, speaking of dollar volume and how it could come into play, let me just show you Apple. And this is always the example I use when you look back, say, at a long-term monthly chart on Apple. Look at the volume. And if you look at the volume now, and I've seen technicians do this, and I mean, the hair on the back of my neck goes up. They look at this and they say, oh, well, volume here is, volume has been so much lower on Apple. This is really bad. We're going up. We keep going up with light volume. This isn't light volume. Take the 1.1 billion shares times the price of the stock and compare it to the price. The price over here is $2.50. And of course, that was the financial crisis. So you can't really even use that. That was panic. But, go in here and look at this and look at where we were in terms of price action. We're 7 times higher here. So we should be able to multiply all of this volume in here by 7 to compare it to this. So hopefully you kind of get that. But anyhow, that is what I had for tonight. What we're going to do next Monday, of course, we have Model ETF portfolio draft tomorrow night. But what we'll do next Monday is I will specifically give you the stocks that I like going forward in terms of the upcoming earnings. And I imagine there'll be 30, 40, maybe 50 of them. And we'll go through those charts next week. So make sure you have that on your calendar for next Monday. And that is a members only event. So again, one last reminder, anybody who signs up for a trial right now gets to come to our member events, even though they're only a trial member. So for $0, you can join us for tomorrow night. You can join us next Monday night. You can join us next month for the Max Payne. You can join us later in the month if we do a January effect seasonality type webinar. All of these are included for any of our members, even if you're just a trial member. All right, anything else, John, or can we go over some questions?
Oh, you know what? There's some questions. I was able to answer them, and you did such a great job. I think we're all set to wind up here.
All right, I'm going to just go through because I think the last time when I ended the webinar, there was a couple of questions that had come in, and I thought maybe I could have given maybe a little different spin, but I'm not really seeing a lot here. Yeah, just hang in there with me for a minute. I'm just going to glance through some of the questions. Yeah, I went through the dollar, so there's no problem there. Is it not a little early to definitively say some of these sectors are going up in 2021? Well, we don't know for sure, but Wall Street is telling us where they're putting their money. I mean, we can wait and just see if it comes back down again, but I don't understand the point there. I mean, for us, we want to know where that strength is and we want to be part of it. So, yeah, I pay attention to the relative strength. And as things change, we're going to change. I mean, our portfolios change every 90 days. So we stick with what's working now. If things change over the next 90 days, we'll be ready to change with them. Would members have access to this spreadsheet? This one's kind of proprietary. I put a lot of time into it. I don't, let me think about that one. We share a lot of stuff that we do. But it, when I work on something for several hours, if I do make it available, I'll probably make it available to annual members. That's normally what we do when we put a lot of time into something. I mean, not that I want to be a nice guy, but at the same time, when you put many hours into a spreadsheet and do an analysis, the thought of someone coming in and just signing up for a trial and leaving and taking it with them, I would rather maybe save it for an annual member. So let me say I'll do that. We'll send it out to anybody who's an annual member. You can take it, and then if you're an Excel wizard, you can do it what you want with it. With large quantities of large office space being vacated, would you agree that banks will take a hit? Yeah, I agree with what John responded to. The market already knows these things. I mean, the banks don't wait for a loan to go bad to take a hit on their P&L. They have a loan loss reserve, and so they've already built in. If anything, the regulators that come in, I used to audit banks, so trust me, I know a lot about banks. When regulators come in, they're more cautious and conservative than CPAs are. When CPAs are doing the audit, I mean, I couldn't believe sometimes how we would look at a loan and, we talk to management about it and say, well, we think you need to specifically reserve it, X dollars. And then a regulator would come in, look at the same loan, and they'd want to double it. And for me, it was like, why? I mean, it doesn't even make sense. But they tend to be very conservative. So when you see these banks taking these huge loan loss reserves, they're already taking the hit. So even if all of these real estate companies do go belly up, it's already built in. But if they come back, what happens is banks reduce those loan losses, and then it goes right back into income. And so that's why a lot of these banks are being bought right now. A lot of the bad news is built in. Is the automobile sector getting stronger because of EVs? Yes, no doubt about it. I mean, any of the companies involved in it, even GM and Ford, they talk about it and their stock goes up, even though on a relative basis, they're not as strong. What would the impact of the stronger dollar in small caps? Well, I've seen it go both ways. I mean, usually if the dollar is going up, normally that means our domestic economy is strengthening relative to others. So you would think that would be a good thing for US stocks, but I've seen it go both ways. So I don't know that I would necessarily draw that correlation between the two. Could you have equities and commodities both going up in a bull market? Yeah, they go up, but on a relative basis, yeah, I think you got to watch the dollar. Commodities led the bull market 2000 to 2008, 7, before we went into the financial crisis. And the reason was the dollar was going down. Since 2011, in the current bull market, the dollar's been going up. And so commodities on a relative basis have been going lower. I think that continues. Yeah, small caps in general or industry specific. Well, I can tell you that small cap, just about small cap, all industries are doing well. In fact, I can't think of any of the industries where their small cap stocks are not performing well. Small caps are doing extremely well in general. Are we able to see the holdings for the ETFs you will be posting? Well, the ETFs, I showed you the ones we're currently holding, but they change tomorrow. And then we'll be announcing those at our member-only event tomorrow night. All right, last week, your webinar persuasively argued that stocks decline almost 9% from 19th to the 25th of every month. Well, 9% is annualized. I'm not saying that we're going to see the S&P drop 9% in 6 days. So if you take that, figure out what that actually is, the absolute amount, it's a fraction of 1%. So it's just that that's the tendency, that the market has a tendency to pull back during a brief period in the month. That's all. As far as why would you buy? Well, if a stock is being accumulated by Wall Street, you may not see that pullback. And that's the way our portfolios have been. Some of them you can get on pullbacks, others never come back. So if you're waiting till the 25th, you might have to pay 10% higher on some of them. I mean, there's just no way really to say. Why would materials underperform? Well, again, it comes down to the dollar. It's not that they won't go up. I think materials will go up. I think everything's going up. Will it go up relative to the S&P 500? It is right now, but remember, the dollar's been coming down. If I'm right about the dollar turning back up, I think that's going to be a headwind for materials, and it may slow them down enough to where they underperform. Still go up, but underperform. What's the scooter stock charts technical rank? Do I think the EEM breakout's real? Yes. I believe emerging markets. I think global markets are going higher. I think we are in for a major global secular bull market. I think we're in the midst of one, and I think around the globe we're just starting to see some of the other indices break out. I'm going to share the Max Payne spreadsheet. I can't remember if I think I did share that. That should be something that's already on the website, I believe. Or if it's not on there, it should be coming. Any concern regarding civil unrest? Well, market setting new highs. I follow the market. I don't follow the news. Will the renewable clean energy go down as the dollar index goes up? That hasn't been an issue in the past. Based on strong dollar, how do we time to exit energy and take profits? I just keep following the charts. Energy is very strong right now. I don't have a problem holding energy. But if it starts to break down and you start to see the relative strength, XLE versus the S&P 500, if that rolls back over again, that's when I would be thinking about getting out of my energy positions. Question on interest rates. Will they continue moving higher? Well, the Fed's telling us they're not going to be doing much with interest rates unless inflation takes off. I think the dollar goes up, which keeps inflation in check, keeps commodities in check. I don't see anything putting pressure on the Fed to do anything with rates for a while, which is part of this secular bull market backdrop. I think rates stay low, earnings expand, and valuations soar. That's what I think. And I've been saying that throughout the year. I'm not just saying it now. I've said it. I said it back in March. Let's see. Thoughts on Chinese tech stocks versus US? I don't really have any thoughts. I mean, some of the Chinese stocks trade here on the US market. Some of those I look at, we do consider from time to time. I don't know. I mean, most of them, I can tell you my expertise is more on US stocks than China stocks. All right. I know the questions are still coming in, but we need to wrap it up. I think I've answered most of those that were already in. So let's go ahead and wrap this thing up. I do appreciate everybody stopping by. Again, if you're not already a member, give us a shot. You're not going to hurt my feelings if you don't like our service and you decide not to stick around with us, but it might change your financial future. And we've had a lot of testimonials from members telling us that this last year, we made a huge difference to them in terms of just our calls, the education we provide, the research we provide. We're getting this from folks that manage their own money. We're getting it from professionals who manage money for others. Just give it a shot. It's no cost, 30 days. But anyhow, that's it for me tonight. Appreciate everybody stopping by. Again, have a great evening. Back at the market tomorrow morning. We'll see what this week holds. We could still be in for a little bit of short-term pain. We'll see. I don't know what future should have just opened, but we'll see what happens this week. But I wouldn't be surprised to see a little bit more profit taking, maybe a little bit more options related manipulation. So anyway, everybody have a great evening and talk to you later. Happy trading.